Hi, everybody. How are you today? Good evening, good morning, good afternoon, wherever you are around the world. My name is Rose Joshua, and welcome to Family and Finance, where we provide you with free information that will help you and add value to your financial decisions and your financial life. Today, I'm going to teach, just spend some time teaching on a subject that we talk a lot about, but many people may not have full understanding. So I'm going to talk about term life insurance, benefits and dangers of term life insurance. Okay, so the objective of my conversation today with you is basically because I want to help us to understand, get a better understanding of how term life works. And the reason is I've seen a lot of people who have policies and they don't understand really what the documentation is saying. And so that's my objective, is to help you to go back, find your policy and take a look at it and get a better understanding. So why do people get life insurance? Life insurance typically we get because we have financial commitments. So let's say I have kids, I want to take care of my kids' education. Let's say I have a home, I like to take care of my mortgage and stuff like that. So if we have financial commitments, financial plans, if we even have any relationship at all, we need life insurance. Everyone needs life insurance, even babies from the day they are born, because they have relationships, right? And they have plans for the future. And so there's different reasons to get life insurance. One of the most common types of life insurance that people get is a term life insurance. And I'd like to emphasize the word temporary. So term is temporary. So as long as you know there's a temporary coverage, that's where we need to start. So term insurance covers temporary financial commitments whose end dates are known and predictable. So if you know that this commitment is going to end at some point that you know for sure, you could use a term to cover that. So there's different terminologies like T10, meaning it's covered for 10 years. T20, meaning something is covered for 20 years. So the end date is known and it is predictable. So examples of correct usage, I've already mentioned children's education, having a mortgage. So here's an example. Let's say you have a child today. You know that that child is going to be going to college in the next 18 years and graduating from college in the next 22 years. So you can get a policy, a life insurance coverage that covers the 22 years to include the child's education, the child's upkeep in the event that you pass away prematurely, all right? So again, we're getting this in the event of death. So let's say you have another example, a mortgage. You buy a house, it's $1 million. You still have a mortgage of $800,000 on it. You can decide to take an $800,000 life insurance policy for the amortization period of the house. So let's say you amortize for 20 years or you amortize for 25 or 30, you will get a term to cover that known and predictable amortization period. So these are examples of temporary insurance. Now, there are ways that we could use term incorrectly. So the opposite of known and predictable will be unknown and unpredictable. So anything that has to do with the end of life, because no one is God, no one knows tomorrow, no one knows when they would die, it's not predictable. Yes, we can predict like maybe we're gonna die at age 120. That's the best we can do. But anything between that, nobody knows. all right? So unknown, unpredictable, end-of-life decisions, it's a no, 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 no to use a term policy to cover those. So anything that you say, okay, when I die, I'll leave this to so-and-so, those are end-of-life decisions. So a lot of people use a term policy for that, and that is a costly mistake, because if you use a term, and we're going to talk about it just in a few slides down. If you use a term for end-of-life decision and then the term had ended, you've lost money. So let's say you took a $1 million policy and you said, okay, it's for end of life, and then the term ended, you lost $1 million. So it's very, very important that you understand when not to use term. So examples of incorrect usage of term policy, again, when I die, for example, I'm going to leave so-and-so amount to my favorite charity. When I die, I'd like my taxes to be paid so-and-so. When I die, this is my funeral expenses. So anything that you are planning for when you pass away, which is unknown and unpredictable, you should not, not that you cannot, but you should not be a term policy. Okay. So in a way, we've talked about some of the advantages and benefits or pros of term policies. So end date is known. So there's something called renewable and non-renewable. So if it's a non-renewable policy, you know for sure the end date. If it's renewable, then you need to know the expiry date. So I'll explain that. So let's say somebody is 20 years old and they get a T10. And let's say the T10 is non-renewable. That means that when they are 30 years old, that policy is dead. It's finished. But let's say the T10 was renewable, but expires at age 80, then they can renew it from 20 to 30, renewal to 40, to 50, to 60, to 70, and that's it. When it's renewed at 70, then it carries to age 80. At age 80, when it expires, it's done, no longer renewable. So you just need to understand whether you have a renewable or non-renewable. But regardless, you know the end date of each term, and you know the expiry date of the entire policy. Premium is fixed. So let's say you get a T25, and let's say the premium is $25 a month. You know you're committed to $25 a month for the next 25 years. Premium fixed flat. And is relatively inexpensive compared to the permanent end-of-life policies, right? Like if let's say you have two policies, you buy them the same day, one is term, one is not term, permanent, the term is relatively cheaper. I don't like to use the word cheap sometimes, but that, you know, just so you get it that way. The other thing you want to talk about is, so we've talked about renewability. Term policies may also be convertible. So conversion means you're able to take the term and change it into a permanent policy down the road. And that is a good feature, because as people realize that term policies that may not be the best solution for certain commitments, they can then choose to convert some or all of their policies into a permanent policy. So what that does is, in the beginning of your life, let's say you don't have high cash flow, you don't have a lot of money, you could then decide to buy a term policy, which you then convert later when your finances get better. So the reason I'm talking about this is because I've seen people who say, oh, you know, I really would like a permanent policy, but I don't have the money now. So why don't we wait until when I have the money? Bad decision. Why? Because nobody is God. Nobody knows tomorrow. What if while you are waiting for when the money comes, something goes wrong, right? So it's best to actually cover yourself with a term than nothing. So every opportunity you get to have insurance coverage, at the very least, get a term. And then when you have money, you can convert it. Do not delay to cover yourself because you don't know tomorrow. You don't know what's going to happen to you. You step out the door tomorrow, anything could happen. So cover yourself. And if the best you can do is an inexpensive term because of low cash flow, then get that and in the future convert. All right. So now let's talk about the dangers of term policies. I like to use the word dangers for this particular teaching today because there are cons, yes, meaning disadvantages, but some of the disadvantages can be really deadly, like really, really bad. So that's why I'm using the word dangers here. So negative is that it is temporary. So you're not covered for end of life situations. So it's not recommended to use a term policy for your estate plan because you don't know when you're going to pass away, right? So the most common disadvantage of a term policy is there's a high probability that you could live longer than your coverage, meaning that your coverage could terminate or expire before you pass away. What that means then is when that happens, your coverage drops to nothing. So that is one of the biggest disadvantages. Now, when the term ends and it is a renewable policy, then you pay more. The premium goes up and renewal costs are high. There's two situations for renewal, and I'm going to illustrate it with tables down in a few minutes. There's when you are able to buy a brand new policy upon renewal, meaning you terminate the existing one, the one that came up for renewal, get a replacement. Only when you're healthy, if you're in good health, you can do that. If you're not in good health, you're kind of stuck with auto renewal. So I'll explain that in a bit. So if your policy comes up for renewal, your term policy, temporary, it comes up for renewal and you don't renew it, your policy amount, your coverage drops to zero. So let's say you had a $1 million policy, you got a T30, you were 20 years old, you get to 50 years old and you're still alive, your policy is done, and you don't renew it, your $1 million coverage disappears, gone, okay? Let's say then you renew, but at some point it expires. Let's say you get to age 80 or age 85, depending on the company, your policy expires and you're still alive, your coverage drops to zero, okay? Now, the next biggest problem is that all the money you paid into the term policy is done. Not recoverable, it is no cash back, and so you've lost your money. So I'm gonna illustrate with this example here. This is an example with a male, 40 years old. Okay, let's see where my Zoom control goes. 40 years old, you take a T10. Let's say, for example, it starts at $25 for a coverage of $300,000. So the amount you paid in the first 10 years is $3,000. Next 10 years is $5,004. Next 10 years is $16,000. Next 10 years to age 80 is $46,000. Over the lifetime of the policy from age 40 to age 80, you pay $71,000. If you live one day longer than your 80th birthday, all this $71,000 is gone, okay? and you have no coverage, meaning if anything happens to you from age 80 plus day one, your family gets nothing, okay? Another example, in unhealthy situation where the person is unable to buy new policies. So this is auto renewal now. And the reason you're stuck with auto renewal, if you have a term policy and you look in your renewal page, they'll tell you the auto renewal amounts. So that's the amount you're stuck with if you're unable to go out there and get yourself a replacement policy when your older policy becomes due for renewal, okay? So when you're forced to keep what you have, it auto renews at a higher rate. So the same T10, but this is auto renewed. You start at the same 25, but the auto renewal at age 50 is 140 instead of 45, for example. And auto renewal at 60 is 320. Auto renewal at 70 is 96. These are just examples. Specific situations are likely to be different. But in this example, you've paid $173,000. If you live one day beyond the expiry date, your $173,000 is toilet paper. So, it's good to understand the dynamics of how these things work. And I have another example here with T20. So T10 is, of course, cheaper, less expensive than T20. And you will see different ads out there. Oh, I can cover you for $1 million for $20. Those are all very cheap term policies that, these examples illustrate, and they're deadly because of the renewals, the way the renewals work, okay? And so in a T20 unhealthy situation, which is auto renewal, from age 40 to 60, 60 to 80, let's say your company expires the term at age 80. At age 80, you become uninsurable. And so whatever money you paid is toilet paper. So again, what we've talked about in this session is term insurance, temporary insurance. We've talked about different durations, T10, T20. There was a T65 that I didn't explain. T65, for example, is term to age 65. A lot of people take that because they work till age 65, and after 65, they stop covering themselves. I don't know why. And then you have, we talked about uses and misuses. And we talked about the biggest danger, which is outliving your term and draining your money, toilet paper. So I hope that was helpful. So if you have a term policy, go take a good look at it. Take a look at what your renewal costs will be. The entry costs are usually very cheap, very inexpensive. So that's the bait. Unfortunately, that draws people into term policies. Inexpensive bait, but then the auto renewal cost can be quite expensive. So you can go from a factor, because sometimes you can go to a factor of more than 20 times the original price. Okay, so I'm gonna do deep dive into other types of insurances in the future. So stay tuned for future videos. So call to action: if you have a term insurance contract right now, connect with me, 780-680-1334. Let's take a look at what you have. Let's take a look at your renewal costs, and let's find options for particularly items that are not temporary in your life, items that should be end of life decisions. And let's cover you properly. Okay, connect with me, Rose Joshua. Share with your friends, family, and don't forget to subscribe. Thank you, and have yourselves a very good day. Thank you. Bye-bye.